decisions of financial market participants, of households, of businesses, amongst other things, depend on what they expect that the central banks will do in the context of their mandate. In most advanced economies, central banks are targeting inflation. They have a mandate of price stability, and that means mostly that inflation in the longer run should be at 2%. Some central banks have more than one objective. The Federal Reserve in the United States has a dual mandate: price stability and full employment. With that in mind, it means that market participants and households and companies, they need to anticipate, they need to try to have a view on how the central bank will react to incoming data, how it will influence policy decisions. That means that they have to try to assess what the policy reaction function of the central bank will be. At first glance, identifying the policy reaction function of central banks may seem like a very difficult task, but fortunately, the central banks have been very clear in recent months on what is going to drive their actions. In his latest press conference, Fed Chair Jerome Powell listed the following elements. 1. The extent of cumulative policy tightening thus far, that is the extent of rate hikes in this cycle. Secondly, the transmission lags of monetary policy, the time it takes until past rate hikes start to have an impact on data in terms of inflation, activity, the labor market, etc. 3. Economic and financial developments. And 4. The incoming data as time goes by. Turning now to the ECB, its president, Christine Lagarde, in her latest press conference listed 3 key factors that are influencing the reaction function of the Governing Council. It is incoming economic and financial data, it is the underlying dynamics of inflation, and it is also the strength of monetary policy transmission. When we compare what is driving the Fed's decisions and the ECB's decisions, actually they're pretty much the same. You find the same elements, the same drivers, and that is not a surprise. After all, the way that the US economy reacts to economic developments, the way it functions, and the way that the Eurozone functions, it is pretty much the same, with this nuance that admittedly the US is less a bank-based, bank-financed economy than the Eurozone is. So reaction functions that are very much the same, but what does this mean for the future? With these reaction functions in mind, how does the future look like? Well, answering that question has become a bit easier following the latest press conferences. Fed Chair Jerome Powell has stated that the current stance of monetary policy is possibly already sufficiently restrictive, whereas Christine Lagarde in her press conference has said we are not pausing and we still have further ground to cover. So interestingly, you have the same reaction function but a very different guidance. And the reason why that guidance is so different is that the current monetary environment in the US is different from that in the euro area. Let's not forget that in the US, the Federal Funds target rate is at 5.25. The inflation objective is 2. In the euro area, the deposit rate is at 3.25 with the same inflation objective of 2%. So more hikes to come in the euro area. Probably the terminal rate has been reached in the US. Now, interesting, when you look at the consensus forecast, we also see that the market is expecting that the Fed will be the first one to start easing policy. Market is expecting already rate cuts towards the end of this year, although would be quite quick, whereas the Eurozone would see the first policy easing by the ECB somewhere in the first half of next year. This monetary desynchronization will have an impact, in our view, on the exchange rate. It is one of the reasons why we expect that the euro will continue to strengthen versus the dollar. But it could also have an impact on the cyclical momentum next year, which could be a bit more positive in the United States compared to the Eurozone. I thank you for having watched EcoTV Week this week and invite you to join us again next week. Thank you.